Hello and welcome to our IEEE Young Professionals webinar. Today we have Stacey He joining us again for the fourth time on her fourth presentation for personal finance webinar series. But before we get started, just some general information. Today I'm your host, Matthew Carius. I'm the webinar specialist for the MGA Young Professionals board. I'm also the vice chair for the global board for the communications and marketing segment. If you haven't known already, we will be giving webinars, host monthly webinars, and sometimes more than one webinar every month in 2015, and then again into 2016. So that's pretty exciting. All questions will most likely be answered either during the webinar or at the end of the webinar. You can ask a question just right below the video there in our IEEE TV format, and then I'll relay those questions back to Stacey. And again, if there are multiple questions, you can upvote whichever question you'd like to get answered first. We kind of started this new initiative in the IEEE Global Board at the global board, and it is free meetup events at high impact global conferences. So we're gonna have a free meetup events at IEEE TechCon in Macau. Web Summit is coming up in November, and there's going to be an awesome soiree event there. We've had excellent meetup events in South by Southwest or International Microwave Symposium. So just be aware of these these free IEEE young professional meetup events at these high impact world renowned conferences. And again, you don't actually have to attend the actual conference to attend the free IEEE meetup event. So just be aware of that. Connect with us online. I would be talking about the Mentor Center Resume Lab at the end of the webinar, but we're on Twitter, Facebook, and of course our YouTube account is filled videos, almost 100 videos on young professional content. However, more exciting is this new IEEE tool called Collaboratech, Bright Minds, Bright Ideas, and we invite everyone to actually join our young professionals community. You can sign up at IEEEcollaboratech.com, and you can actually join our young professionals community. We will be sending out emails in the coming weeks regarding IEEE Collaboratech, and more specifically what our young professionals community on IEEE Collaboratech can offer. So please go ahead and join us there. Today's webinar is, like I mentioned before, it's a personal finance webinar series, part 4. Stacey He has been with us throughout the whole year, and I'm quite excited to see what she has to offer us today. So Stacey, please go ahead and take it away.
Okay, hi, thanks, Matt. Hi, everyone. So, as Matt was saying, this is part 4, and today I thought we talk about the right ways to save. In the past webinars, I've discussed about budgeting and investment, but a question that I get often is, when should I save, and how much should I save, and do I really need to save for retirement at such an early age? And so I thought, I think it would be a great session to just talk about the different phases that we go through in life, and how do our finances fit in. So I read this article in Money Sense magazine. So I'm not, this is not my original idea, but I thought this was really good, a really good breakdown. So what they had done was they said, each of us go through life in 3 stages, right? There's the early working years, then there's the crunch years, and then finally there's the prime saving years. So I'm going to go through each of the stage with you and discuss the financial priorities in each of the life stages. So the early working years, right, what I think a lot of you fall into, is after you start your career, but before you buy a house and start a family. So this typically begins in your 20s and probably going to extend into your 30s. So the typical priorities are, if you fall into this category, is living within your means, right? I talked about the golden rule for budgeting before, which was the 50-30-20 rule. For those of you who are not familiar with that rule, it essentially says 50% of your income should go into essential purchases, right? So rent, food, things like that. 30% should go to entertainment. So that's going out with friends, vacations, things like that. And 20% should go into savings, right? You could also do the 60-30-10 rule, which would also work. But really, the top priority is to live within your means, right? So following that, and then paying down your student loans. So if you're in your late 20s or early 30s, you may still have loans left over. And so debt repayment is very, very important. And I'll go into a little bit more detail about when should you pay down debt and when should you save next couple of slides. Now is also a good time to invest in your career, of course, pursuing either professional designation or furthering your education. And also saving for something productive, right, if you can. So that most of the time would involve a home, or if you have aspirations to start a business, then perhaps to start saving for that. So you see, I don't mention retirement savings here because, you know what, quite frankly, it's too early. You have a lot of things on your plate, and right now may not be the when you're in your late 20s or early 30s, retirement is probably not the top thing to think about. Now, there are some exceptions to the rule. So if your employer matches your contributions, right? So if you work in a place where let's say you put in 4% or 5% in your RSPs, and your employer matches that, so they match the extra 5%, and there you have it, 10% in savings. If you have that, please contribute into it. Because that's free money, right? So you don't need to be saving outside if you have an employer pension plan, because in a way it's forcing you to save. And the other thing is, if you don't, if you fall into the category of you don't really want to buy a home, and I see this more and more often now because housing prices are so expensive and our pay hasn't kept up. A lot of people just want to rent until maybe in their 40s, and then they will buy a bigger home. So if you don't want to buy a home, then it would be a good idea to actually start saving for retirement as early as you can. So you can see it's all a matter of what you prioritize, right? But if you're like most people right now, you are saving for a home, you're paying off your debt, and budgeting, right? So what are some of the investment vehicles to use in this stage of life? Well, RSPs are actually not the best idea. What you should use are TFSAs and high interest savings accounts. And the reason I say that is because the goals that you're all saving for at this stage in life are all short term. If you're buying a home, it's probably within the next 5 or 6 years, and that's a short term investment. If you're saving for a vacation, that's short term. So you want to use investment vehicles that are flexible, that you can take money out easily versus the RSP. In terms of a high interest savings account, I mean, I don't want to get into too much detail about that, but here in Canada, there's, you got the big banks, right? But their rates are very low. So I think TD or CIBC or something like that, they're all at 0.5 or 0.6%. And that's only if you have a minimum of $5,000. So you want to find an institution that gives you a good interest rate. One example is a Canadian Direct Financial. You may not have heard of them, but they offer about 1.5%. And they are also protected under the CDIC. So that means, as all institutions are, so that means if you have less than 100,000 and the institution happens to go bankrupt, let's say for some reason, you're guaranteed to not lose that money. The government will pay that back to you. That's CDIC insurance. So anyway, so knowing which bank and which institution gives you the highest rate is also very important, right? Don't just put your money somewhere random. So remember how I talked about how RSPs are not as useful, but there is an exception to the rule. It's if you were to buy a home or to further your education, in which case you get to withdraw money tax-free from the RSP, right? So if you used to buy a home, it's $25,000 that you get to withdraw tax-free. So unless it's for the home, you really shouldn't be using the RSP just yet. You want to stick to something that's shorter term, like a TFSA or high interest savings account. So I'm going to talk about the balance between paying down debt and saving. And this is, I always get this question, right? I think this is a very confusing area. So I'm going to pull up some numbers for you just so I can tell you when is a good time to actually pay down the debt. So let's say this is a typical scenario, right? Let's say you have $12,000 of a line of credit from school, and you want to pay off ASAP, and you have this extra $300 a month, and you're wondering, should you put it down towards debt or should you save towards something? Well, let's take a look at it in terms of how much interest it will cost you. So let's say the interest expense is 5.5% here for this example. If you pay $245 a month, right, it would take you about 5 years to pay the debt off. But what's interesting is you want to look at how much interest that this loan will actually incur, and it's about 1,800 over the course of 5 years. That's actually very little if you think about it in the large scheme of things, right? So if that's the case, you may want to use that extra 300 towards something else, such as saving for a home or vacation or something. So you may not want to be in such a hurry to pay off this debt because the interest expenses are low. However, this example completely changes if your interest expenses are high. So let's say your interest suddenly is 12% and the debt amount is 20,000, right? If you want to pay it off in 5 years, it's 456 a month. But look at the interest; it's about 7,000, significantly higher. Of course, the balance of the debt is higher, but because the interest rate is much higher. So when you ask the question, should I pay down the debt or should I invest? It's all a matter of how much the loan is and what the interest on it is. So sit down with your financial person and have them calculate how much interest it will cost you. Because if you look at the previous slide, at 1,700 for 5 years, really not a big deal. Whereas 7,000 is a big deal, right? So you want to put that extra money towards the debt in this situation. So that's how we determine what you should do. And obviously each person is unique because you all have different debts and different interest rates. Just to give you some perspective on, if you're young and you say, I have this extra money and I don't really have a student debt and I don't really want to buy a home, or I want to buy a home, but I also have extra money, and you actually want to save for retirement, then you are in an amazing place that most people are not. Look at how much you get to accumulate in retirement if you just save $100 a month from the different ages that you begin. So if you're 25 years old today, if you're in your late 20s and you save $100 a month, you could accumulate to about $500,000 by the time you retire. Right? That's a lot of money. If you start at 35, at $243,000, 45, $106,000. Look at 55, $35,000. Right? Those numbers are pretty scary. So if you are able to save even just a little bit, and you're young, then by all means go ahead. And to give you some context in terms of what this all means, this is how much you need roughly at retirement, about $1 million by the time you're 65, right? So if we look back to the previous slide, at age 25, if you save $100 a month, it's $500,000. So you're almost halfway there by just putting $100 a month, right? Everyone can do that. So just to give you some perspective on how much to really save. So next stage of life are what I call the crunch years. This typically are the first few years after you bought a home and you started a family. You are in your early 30s, but it can be earlier or later, right? So this typically spans from 30s to 40s. Your priorities here is to get through the crunch with your head above the water. So right now the expenses in this stage of life are the highest, right? You've got child expenses, your mortgage, some house renovations. So your expenses are through to the roof. So it's really important that you try to avoid consumer debt and credit card debt, right? This is top priority. Try not to take on any more debt. Having paid off your student loans, you don't want to take on more. And this is what I mean by surviving with your head above the water, right? Your major exceptions, though, are if you continue to not buy a home, then you should definitely put saving to retirement a priority. And also, if you have an employer that matches your contribution. So let's say your pension plan is what they call a defined benefit plan, which are rare these days, but they do exist. And in which case, your RSPs will be guaranteed, right? Your retirement income will be guaranteed at retirement. In which case, you definitely want to participate in that, and you don't have to worry as much about saving outside. What's interesting, though, during the crunch years is that even though the finances are hard in the beginning, they actually get easier towards the end. And the reason being, mortgage payments are pretty much flat, right? Your mortgage payments don't really change. It's over 25 years. At the end of 25 years, you'll pay it off. Child expenses tend to be high in the beginning, and they also level off as the children get older. And what's important to remember is that your income is actually increasing during this period. So you may reach your peak earning years or close to that. And so towards the end of the crunch years, you should be aggressively saving. Right? So it's a natural progression. Right? In the beginning, it's hard, but then as you progress through, it gets easier and easier. Then we reach what we call the prime saving years. Right? So this is after you start to get your mortgage and family finances under the control, and it's really time to get down to saving for retirement, because now you are in your early 40s or mid 40s or late 30s. You got to save now. And the typical priorities at this stage in life are paying off your mortgage, building a financial savings as quickly as possible, and finding the key in this stage is finding the balance between paying off the debt, which is your mortgage, versus the savings, right? And it's all about what the interest rate is for your mortgage versus how your investments are doing. You're also contributing to your children's education at this point, if that's important to you. Major exceptions are if you remember how I talked about in the crunch years, try not to build up debt. But if you did, then now is a time to pay it off, right? So if you have accumulated some consumer debt, then instead of saving for retirement, you've got to deal with that first. And another exception is if a lot of people at this stage in their lives, they want to start a business, right? In your late 30s, early 40s. And if that's the case, then you've got to put retirement on a hold as well. Okay, so there's some exceptions to the rule. I'm going to give you an example of, this is a typical, young professional financial situation, and I think a lot of you might fall into this scenario. And so I'm going to kind of go through how to better use your money, right, in this situation. So let's say meet Lisa. She's 30 years old. Her income is $90,000. She has $35,000 in her savings account. So she's managed to save a little bit here and there. She has $20,000 left in her student loans. Here are some of Lisa's goals. She wants to pay off the loan ASAP, right? She wants to own a starter home in 5 years' time, reduce some taxes, and of course, traveling is very important to her. So she wants to be able to travel every year. So how do we? So instead of trying to save $300 towards the home and $500 towards this, how do we use this money more wisely? So this is what we're going to do. So Lisa's net income is about $4,800 a month. What she can do is start contributing to the RSP, right? And the reason being, she can use the home buyer's plan to withdraw the $25,000 tax-free. So let's say she saved $500 a month. In 5 years, she'll have $30,000, enough for a down payment of a $450,000 condo. The $500, because it went into an RSP, she will get a tax refund every year, right? And at her tax bracket, she'll get about $2,300 in tax refund. See, that tax refund can be used to either towards her vacation or to pay off the student debt. So it depends on what she wants to do. 1 year, she may want to go on vacation using this money. The next year, she may want to pay off the debt, in which case the debt will be paid off faster as well. And on top of that, you don't have to save, Lisa doesn't have to save extra for a vacation, right? Now, so the house and the debt is taken care of, and the vacation is taken care of just by putting money into the RSP. And then what you want to do is save for the house, right? So save $360 a month for the condo. The debt. So $360 paid towards the debt, and the loan for the $20,000 will be paid off in 5 years, right? So before the house purchase, her student loan will be paid off, and then she can take on a mortgage, right? So if we fast forward 5 years from today, her debt is paid off at $360 a month. She now owns a condo, a $450,000 of a condo. Remember the $360 that she was putting towards the debt? See, that extra money, don't use that for fun or for something else, because you were able to live without the $360 prior. Continue to have the same standard of living. Use that $360 to put it towards an RSPs for retirement, right? So you don't have to create extra cash or make extra money. You just have to redirect the funds. So the $360 now goes to retirement, which at $360 at age 35, so she's 35, at $360 a month, it will give her $520,000 at retirement, an equivalent of $17,000 a year from 65 to 90 tax-free to her, right? And this is all without considering the fact that her income will increase, all based on her current income. Because she's contributing $360 towards the RSPs for retirement, she's also generating tax refunds. So the tax refund on $360 a month will be $1,800 at the end of the year. Now what she can do is use this tax refund to pay off the mortgage, and her mortgage will be paid off faster than 25 years. So you see, it's not even about making more money or spending less. It's just about using it smartly and redirecting it, right? So that's, a lot of you will fall into somewhat of this profile, and I think this will be a really valuable an example for you to follow. Okay, so that's really the end of this workshop. I really hope that you got some good points from it. And I think the main thing that I wanted to kind of help you understand is that you don't have to panic. When you read magazines that says if only 48% of Canadians are saving for retirement. Well, you know what? That's about right, because not all of you should be saving for retirement. at the same time, they are priorities, and you would adjust accordingly. So thanks, guys. But I'm open up to questions now if you have any.
Thanks, Stacey, for a very informative webinar on saving. And you did touch a lot on registered retirement savings plan. So again, if you're listening, please go ahead and ask a question if you have some. I think I'm gonna start off with something I've been thinking about. Well, I haven't done it personally, but so you see people moving away from RSPs, and you outlined a very good example on why you should contribute to RSPs. But then people are moving away from that and investing in real estate because the way I understand it, maybe you can probably clear this up, is that you're a lot more liquid in real estate in terms of paying less tax when you want that money when you retire. Yeah, when you retire, so you're not paying as much taxes on real estate investments when you're retired, whereas RSPs you are taxed on whatever you withdraw from the account. Can you maybe comment on that? I'm not sure if you know a little bit about that, but like that's something that like I've kind of heard over the years, but maybe comment on that.
Yeah, sure, absolutely. That's a really great question. So with real estate, you talked about how at retirement the taxes will be lower, right? So that's if you were to buy a home you lived in. So real estate comes in two forms. One being you buy the home and you live in it as your principal residence, and the other form is you buy it as an investment property. If you buy it as a principal residence, which you live in it, then yes, when you retire and you sell the home, you don't have a capital gain. There's no tax on it. Whereas if you buy an investment property, if you're earning rental income, you have to pay tax on that. And if you sell it, you will get taxed on the gains, right? So there's two different tax consequences. But let's say that, for example, you buy the home and you think this is a great idea because you don't get taxed, and you want to. And the reason you're doing that is then you can sell the house for, let's say, $1 million or something, and use that money to retire on. That's a good strategy, except what happens if there's a housing crash, right? So from a tax perspective, yeah, it makes a lot of sense. But from a general economic sense, I don't advise on putting all your money into the home and having no savings. Because what's scary about that is if there's a housing crash, which it has happened, and it's happened in the States, and that's the time you are retiring and you're trying to sell your home, you may not be able to sell it at a gain. Then what are you going to do at retirement, right? Okay. So that's not it's a good idea from a tax perspective. I agree with you, but from a overall financial perspective, I believe you got to do both. You got to have a home that you're going to pay for, but you also have to save some money aside. And also, just on real estate, if we look at it on average, I'm not talking about a particular property or particular house, but on average, probably historically, houses have gone up about 6% over the years. But if you look at investments, they have the potential to be a lot higher than 6%. But then housing is more stable, whereas the investment markets are a lot more volatile, right? So it all is a matter of, can you stand that volatility? Can you stand that risk of going up and down? Whereas real estate is really just somewhat steady. But a lot of people have said, Toronto especially, it might be a housing bubble. There may be a crash, and that might be true, right? But we just don't know when. And if you can ride that out, if you can say, even if there is a crash, but I'm young and I can live through that, then great. Then invest in that real estate, right? But if you were to buy, let's say, a condo today, and you say, I want to flip it and I want to sell it, and I need the cash in this many years, that's more dangerous, because what happens if there's a crash at that time when you want to sell?
Okay, so I guess it just comes down to risk and the amount of risk you want to actually put. So maybe again, just clarifying RSPs. So RSPs are registered retirement savings plan. You can put your money into multiple funds, right?
Yeah, so the RSP and the TFSA are what they call, they're investment vehicles. Within the vehicle itself, you can invest whatever you like. So within the RSP, you can put stocks, bonds, mutual funds, cash. You can put anything you want, and that's the same for TFSAs as well. So you can see it like, RSPs and TFSAs are like a house, and the furniture are the funds in it.
Okay. Okay, so then within that vehicle, you can kind of play around with the risk that you want. You know,
Mhm.
if you're in more volatile funds, then you're higher risk. But like, okay, so
Yes.
because I'm kind of alluding to a question we have from the States where
Mhm.
do I have to invest in RRSPs in the country where I live, or can you have an RRSP, or can I invest in RRSPs in other countries?
Oh no, it's country specific. So Canada is RSPs, right? In the States, it's completely different. You have 401ks and things like that. So you have to invest in what your country has. So you cannot. So if you're in the States, you cannot invest in an RSP in Canada or any other country. You do your own thing, right? It's a because see RSPs is based on the income you earned in Canada,
Okay, yes.
right? So if you're in the States, there's no way you would have earned income in Canada, right? So that's why it wouldn't apply to you. But you would have an equivalent in the States, an equivalent vehicle in the States.
Okay, that actually makes sense. Maybe again from that question, so RSPs in Canada are the vehicle. Can you have foreign funds in an RSP, or do they have to be Canadian funds?
No, you can definitely have foreign funds. So let's say mutual funds. There are mutual funds that are U.S. mutual funds. There are international funds. So they are European ones. Right. So they only have investments in Europe, and that's perfectly fine. You can have those investments within the RSP. So even if let's say you're in the States and you want to invest in Canadian funds, that can be done too, right?
Right.
It's just a vehicle that's different, but the investment itself you can have across the world, no problem.
Right. Okay. And maybe just one last question before we end it off. So you mentioned you need about $1 million by the time you're 65 to actually retire. How much interest would that have accumulated? Like
Well,
how much a year like off the entrance is that? I was wondering where you got that number from.
okay. Well, see, it's so a million. What I assume though is your investment return is about 6% on average
Okay.
over the course of the year, over the years, right? So there could be 1 year it's plus 40, another year minus 35. It doesn't matter as long as on average over that span of 30, 20 years, it was 6%. So I assume that your interest that you're accumulating on it is 6%.
Mhm.
Yeah.
Okay. Okay. And again, okay. So say you have $1 million in RSP and you retire, and then you want to take out $100,000 or $200,000 or whatever it may to be to buy a cottage, and you want to just retire there. Are you
Okay.
are you taxed on the whole $200,000, or are you taxed only on the interest from that $200,000? I'm just confused.
Yeah, so when you're so let's say if you put the money in, you had accumulated that money in an RSP, right?
Yeah.
So you got a tax refund upfront. When you withdraw it, there's going to be tax on it on the entire amount that you took out.
Okay.
Yeah, so it's the entire. So ideally, this is why you have to have. This is why I say you have to have RSPs and TFSAs because let's say you wanted to buy a cottage and you have 300,000 in the TFSA and you have 700,000 in the RSP. What you can do is then withdraw the money from the TFSA to buy the cottage instead of the RSPs because money from the TFSA is not taxed, right? So you want to plan it properly so that not all your money are in the RSPs because there are very heavy tax consequences on that. But you have TFSAs which can accumulate to the hundreds of thousands of dollars if you do it properly, and you can
Right.
use that. Yeah.
So we have one more question from Canada that actually just came in. Hello, I'm currently financing a car at 0%. However, it takes up a bunch out of my income. Should I pay it as soon as possible, or should I sell it and pay off the difference and get a cheaper car?
Oh, that's that's an interesting question. I guess it all depends on how much it's hard to answer that question because I don't know what your other financial situation is like.
Exactly. Yeah.
It's very hard to answer, but I've always, as a general rule, if I don't have to finance something, I don't finance it. So if you can't afford to, sell it and use cash and just decreasing that monthly leasing expenses, I would always do that, right? I don't like the idea of financing or taking a loan to buy a car and things like that because it's not an asset, right? It's more of an expense. So on a general basis, yeah, I would try to get out of the lease or financing if I could.
Right. That's actually a good point. Even though you're at 0%, I think sometimes the terms for that is that after X amount of time, if you haven't paid anything, then the 0% turns into like 10 or 12% or something like that.
Right, right. Yeah, I mean, it's nothing is free ever, right? And if they say 0%, there's got to be something behind that. So if you, it's probably in the footnote or something, but try not to get into that that pattern.
Into that regime.
Yeah.
And I guess like I'm very fascinated by personal finance and investments.
Mhm.
And which so I just want to reiterate. So it's always if you have to have debt, what's the best kind of debt to have?
Okay, good question. Not all debt are bad, right? So if you have a mortgage, that's not bad. But if you have a mortgage that you cannot afford, then that's pretty bad. But normally, if you're using, here's how you look at it. Ask yourself, what is this debt used for? If it's used to buy things that are not assets, so if you use debt to buy a car, a vacation, something that's fun, right? That's bad debt. You don't want to accumulate debt for that. However, if you're using debt for further your education, buying a home, some people even use leverage. They borrow money to invest, right? If they can afford the mortgage, the interest payments, and those are good debt because you're using that debt to build up assets. So how you judge is if you ask yourself, am I using this debt? Am I using this debt to buy a bag? Then it's a terrible idea, right? Because a bag is not an asset, nor is a but house, investment, your career, your business, your further your education. These are all good debts.
So you would recommend if you have some money to actually take on debt for investments?
Yes, you know what? But that is definitely not for everybody. Okay,
Yeah.
this is a really footnote. Yeah, definitely not for everybody. If you have what debt? Okay, what I'll give you a typical profile of what the strategy would be, who the strategy would be good for. If you make a good amount of money, right? You are a highly skilled, trained professional. You make good money. You are behind on your investments. So you didn't really do very well in the beginning. You spent a lot of money, and now you're towards a little bit later half of the year, and you don't have any savings, but you have a good cash flow, good steady paycheck. That might be a good idea because you need to aggressively build that portfolio. That's one profile. Another profile is if you're a really good saver and you're young, you can take a lot of risk. You save well, you have all this cash, you just don't spend that much, and you want to build your portfolio really fast. You can take on a lot of risk, and you want to retire early. You can take on debt to invest as well. So it fits very specific profiles, right? It's not everyone should take on this debt, but yeah, it is for some people. It can be an amazing strategy. For others, it can be a total disaster.
Fair enough. That's actually a good point. Like I always kind of thought about who can actually do that. I don't think we have any more other questions coming in. So thanks, Stacey, again for an awesome webinar. Please complete for everyone listening in. Please complete our feedback survey. I'll be giving that out. Our next scheduled Young Professionals webinar will probably be from Stacey, hopefully in October, but we haven't finalized the date yet, but that's fine. But we do have some insurance webinars coming up in November for member benefits, which includes Clements, Mercer, and personal insurance. So please stay tuned for that. We do have career-based services for all of our young professionals member, the Mentor Center and the Resume Lab, which is available for free for our young professionals member. And if you have any suggestions for other young professional products and services, please shoot us an email at the email address shown there. Again, I'd like to thank everyone for participating in this webinar, and everyone have a good rest of the day. Thank you.